All right, let's get right into it. For decades, there's been this puzzle kind of haunting the stock market. It's a really strange and persistent thing that just seems to defy common sense. And it's all about what happens to companies after they issue a ton of new stock to the public. I mean, you'd think that's a good thing, right? A sign of growth and strength. Well, as it turns out, the data tells a completely different story. And that question right there is the central mystery we're going to unravel. Why is it that when a company is doing so well, so hot that it can sell brand new shares to an excited public, its stock then so often just fizzles out and underperforms for years to come? It feels totally backward, and for a long, long time, it's been one of finance's great unsolved cases. So, here's the puzzle in black and white. On one side, you've got these companies issuing new shares, and their stock tends to lag the market. But on the other side, you have firms doing the exact opposite, taking shares off the market with buybacks, and they tend to beat the market. It's this super striking, really consistent pattern, and it's just begging for an explanation. To solve this mystery, we've got to start with our prime suspect, and that's the theory that this is all about some very, very cunning managers. This whole idea was famously laid out back in a 1995 paper. And the theory, it goes something like this. Managers, the insiders, they know when their company's stock is trading for way more than it's actually worth. So what do? They cleverly decide to sell a bunch of new shares at that inflated price. They're basically getting a fantastic deal for the company, but it comes at the expense of those new investors. So this sets up a simple four-step playbook. Step 1, managers see their stock is overvalued. Step 2, they pounce, issuing new shares to cash in. Step 3, the rest of us, the investors, we slowly start to realize what's happening. And step 4, the stock price eventually and kind of painfully corrects itself and falls back to earth. It's a really intuitive story of savvy insiders versus slow-to-react outsiders. And for a long time, this was pretty much the accepted wisdom. But what if that whole story is just wrong? What if there's a much deeper, more rational economic force at work here that has nothing to do with managers trying to outsmart the market at all? And that leads us to a completely different angle, a more rational explanation, one that's often called the investment theory. Now, the central idea of this new theory is really powerful. It says, forget about cunning managers. The key word here is investment. The whole argument is that the decision to issue stock isn't the cause of those future low returns. It's just a symptom of something else entirely. And that something is the company's investment strategy. Okay, to really get this, we need to talk about a core economic concept, decreasing returns to scale. Think of it like a gold rush. The very first miners to show up, they find these huge, easy-to-reach gold nuggets right on the surface. But as more and more people and money pour in, the new miners have to dig deeper and work harder for smaller and smaller flakes of gold. It's the exact same in business. A company always goes after its best, most profitable projects first. So every additional project it takes on is probably going to be a little less profitable than the last one. Okay, so let's connect the dots here. Let's link a company's actions directly to its stock returns. Check this out. A high-growth firm, one that's flush with opportunities, is investing a ton of money. Now, because of those decreasing returns we just talked about, the expected returns on all that brand new investment are naturally going to be a bit lower. And what do these high-investing firms often need to do? You guessed it, issue stock to fund everything. Now flip that. A mature firm, one with fewer amazing projects on the horizon, invests less. That means its expected returns are higher. And what does it do with all its extra cash? It buys back stock. The connection is suddenly crystal clear. High investment goes with issuing stock and leads to lower future returns. Low investment goes with buying back stock and leads to higher future returns. And this is all just tied together by a really simple accounting rule called the flow of funds constraint. It just means that the money coming in has to equal the money going out. So if a company wants to invest a huge amount, way more than it's making in profit, that cash has to come from somewhere. And very often, that somewhere is a new stock offering. And this brings us to the complete rational explanation. So a firm sees tons of growth opportunities. It invests like crazy to go after them. But because the best projects always get picked first, the average expected return on all this new investment is just mechanically lower. And to pay for it all, it issues stock. All of a sudden, the stock issuance isn't some trick. It's just a public signal that the company is in a phase of high investment, and therefore, predictably, it's going to have lower future returns. Now, what makes this theory so compelling is that it doesn't just solve our main puzzle, it also solves a bunch of other connected mysteries. Let's look at some of the supporting evidence.
For example, the model predicts that companies should issue stock way more often during economic booms. And would you look at that? That's exactly what the data shows. During expansions, when investment opportunities are everywhere, stock issuance is sky high. But during contractions, it pretty much disappears. This fits the investment story like a glove.
It also explains this fascinating pattern in company performance. The data shows that firms tend to issue stock right after a period of absolutely incredible operating performance, but then, almost like clockwork, that amazing performance declines back toward the average. But here's the thing. This decline isn't a sign of failure. It's actually a textbook case of something called regression to the mean. These companies weren't tricking anyone. They were simply at the peak of a hot streak. And hot streaks, by their very nature, just don't last forever. The stock issuance just happens to take place at that peak moment. You know, this theory even helps solve a puzzle within finance itself. For years, standard tests have shown this weird result, that a company's investment level is a better predictor of its returns than its risk. And that just didn't make sense. This model argues that's not because risk doesn't matter. It does. It's because our tests are just too noisy to measure risk properly. In reality, risk is the true driver, but high investment is such a clear and powerful signal that our imperfect tools end up picking up on that instead. Now, look, no model is perfect, and it's important to be upfront about that. While this investment theory explains a ton, it doesn't quite nail the full size of the outperformance we see after companies buy back their stock. It also has some trouble explaining why this whole effect is so much stronger for what we call value firms in the real world. So yeah, there are still a few corners of this mystery left to explore. And that leaves us with a really fascinating final thought. If this one single rational idea that high investment leads to lower expected returns can explain so much of this billion-dollar puzzle, then you have to ask, how many other so-called market anomalies aren't anomalies at all? How many are just the logical, predictable outcomes of companies simply trying to make the best investment decisions they can? It really suggests that sometimes the simplest explanation is also the most powerful one.